Welcome to the Pro Ticker Deep Dive.
Yeah, it is really good to be back. And honestly, I don't think we could have picked a more chaotic or contradictory day to just sit down and look at the tape.
Chaotic feels like a bit of an understatement, honestly. I
Okay.
mean, it feels like we are looking at two completely different planets today. It is
Yeah.
February 26, 2026. And if you just look at the Dow Jones, you would think, you know, hey, pretty boring day, steady as she goes.
Yeah, just a normal Thursday.
Exactly. But then you look over the NASDAQ or you look at the internal damage happening in software stocks, and it looks like a bomb went off.
It is a day of just massive cognitive dissonance. You have the broader industrial economy holding up fine, and then you have the digital economy, the exact thing that has driven the market for the last 15 years, having this complete existential crisis.
We really have to set the scene properly for you today because the headlines are screaming about a dozen different things at once.
So many moving parts today.
Right. We have NVIDIA, the absolute king of the market, crushing earnings. Blowout numbers.
Yeah. Unbelievable numbers.
And the stock is down. We have this viral research report that basically claims the entire software industry is walking dead. And that in the background, as if that wasn't enough, we have a literal constitutional crisis over tariffs and nuclear talks happening over in Geneva.
It is what I'm calling the triple threat.
The triple threat, I like that.
Yeah, that is how I categorized it in my notes this morning. You have the AI narrative cracking, you have the earnings reality check, and you have these macro shocks, and they are all just violently colliding on this specific Thursday.
Let's call it what it really is. It is the great realignment.
That is exactly right. We are moving from a market that was just completely obsessed with limitless digital growth, where you could buy anything with a ticker symbol and an AI domain name and make money, to a market that is suddenly terrified of digital disruption.
And the money is fleeing right back into the physical world.
Yes, into things you can actually touch.
We're going to unpack all of that, but I want to start with the thing that has my phone just blowing up all morning.
Let me guess. The Substack report.
Yeah, it's this report from Citrini Research.
It's the Trini contagion. That is what the trading desks are calling it.
It's the Trini contagion. So the title is The 2028 Global Intelligence Crisis. And, it sounds like a bad sci-fi novel, but the market is treating it like the gospel truth today.
They really are.
We are seeing these massive sell-offs in Salesforce, Uber, DoorDash. Stocks that you usually think of as pretty safe tech utility plays are just getting hammered.
It is so fascinating because Citrini Research explicitly framed this as a scenario.
Right? They literally said it was a scenario.
They put it in bold letters at the top. Scenario. This is not a hard forecast. This is a what if.
But nobody reads the fine print.
Exactly. In a market that is this jittery, this on edge, nobody reads the caveats. They read the headline, they see the underlying logic, and they just hit the eject button.
So walk us through that logic, because you and I have heard AI will disrupt everything for 3 years now. Why is this specific report causing a 25% sell-off in Salesforce over the trailing 12 months?
Well, to understand why the panic is happening today, you have to understand the core thesis of the report. And it all centers on this concept of agentic AI and something called friction.
Okay, let's break down friction. Because usually as a person going about my day, friction is bad.
Yeah.
I do not want friction when I am trying to order a coffee or buy a pair of shoes.
Right. You, the consumer, hate friction, but the economy absolutely loves friction.
Explain that.
In fact, a huge percentage of the S&P 500 is built entirely on monetizing friction. Think about what a company like Uber or DoorDash actually is at its core.
They are middlemen.
Exactly. They sit between you and a driver, or you and a restaurant. They built a very nice, shiny user interface to smooth over that friction, and for that privilege, they take a massive cut of the transaction.
Okay, so they are basically a toll booth. A toll booth on the highway of human interaction. And Salesforce is the exact same thing when you really look at it. What is a CRM? Customer Relationship Management.
Right. It is just a giant database. But it has a user interface designed for human beings to input data, track their sales, and manage their customers.
And you pay for seats.
Yes, the A-seat-based model. You pay $100 or $200 a month for a human to sit in a chair and stare at that interface.
I see where you're going with this.
Enter agentic AI. We are not talking about a chatbot that writes a cute poem or helps you draft an email. We are talking about autonomous agents that can execute complex tasks across systems.
Agents that can actually do the clicking for you.
More than that, they navigate the web, they interact with APIs, and they manage databases without a human ever needing to look at a screen.
So the Citrini thesis is basically, if I have an AI agent They can just talk directly to the database or talk directly to the restaurant's AI agent.
Then the user interface becomes completely obsolete.
Wow.
And if the user interface is obsolete, the seat is obsolete.
Why buy the seat?
Exactly. Why would a massive corporation pay Salesforce for 50,000 seats if 45,000 of those humans are being replaced by autonomous agents?
Because the agents don't need a graphical interface.
They interact with the code directly. They don't need colorful buttons or dashboards or drop-down menus. They just send data back and forth.
That is the phrase the report uses, right? The unwind.
Yes, the unwinding of the human intelligence premium. It is a really brutal concept when you sit and think about it.
Break that down for us.
The report argues that the massive premium valuation we give to these software companies is entirely based on the idea that they control the human workflow.
They own the screen the human is looking at.
Right. But if the workflow moves from human to computer to computer to computer, that premium just evaporates overnight.
Because the moat was the interface.
Exactly. If the interface is irrelevant, the moat is gone. The value is gone.
And that is why we are seeing this sheer violence in the stock prices today. It is a re-rating.
A brutal re-rating.
The market is looking at Salesforce and saying, wait a minute, are you a high-growth tech company or are you a legacy interface company that is about to be entirely bypassed?
Precisely. Just look at the price action today. Salesforce down roughly 25% over the trailing 12 months. That is a disaster during what is essentially still a bull market for other sectors.
And they announced a $50 billion buyback.
I know. And a dividend increase, too.
A $50 billion buyback should send a stock ripping higher, but instead, it is struggling.
Because in this specific context, with this narrative swirling around, the market is interpreting that buyback as a white flag.
Like they don't know what else to do with the cash.
Exactly. Investors see the buyback and say, oh, you can't find any growth. You can't innovate your way out of this agentic AI threat. So you are just buying your own stock to prop up the price.
It feels like the market is accusing them of financial engineering, just to hide a deep structural problem.
That is exactly what is happening.
Well,
and it is not just Salesforce getting hit. Look at the capital-light software names across the board.
Datadog.
Datadog is getting crushed. CrowdStrike. Zscaler.
Drops of 9% or more in previous sessions.
These companies have been the absolute darlings of the last cycle. Why? Because they have incredibly high margins and very low capital costs. But today, they're dropping 10%.
Because if the volume of software creation just explodes via AI, if AI can write the code, but the value of the interface collapses,
then pricing power completely collapses.
Yeah.
This is the absolute nightmare scenario for SaaS, software as a service.
right?
Because think about it. If an AI agent can just code a bespoke security tool for your specific company or a bespoke database manager in 10 minutes,
Why am I paying CrowdStrike a premium monthly subscription?
you aren't. It turns software into a commodity, like wheat or corn.
And you don't trade wheat at 20 times revenue.
No, you trade it at 10 times earnings. If you were lucky.
That is the re-rating we are seeing.
The market is trying to front-run a potential collapse in software margins, a collapse that might not actually happen for 3 or 4 years.
But it is happening the price today. It is very much a sell now and ask questions later mentality.
Which is classic behavioral finance. It is contagion. Investors are sitting there looking at their portfolios today and saying, I own a lot of things that charge a monthly fee for a login screen. Is that safe?
And the resounding answer today is no.
A hard no.
This brings up such an interesting paradox, because for years, the dominant narrative was software is eating the world. Mark Andreessen said that over a decade ago.
Right.
Now the narrative is AI is eating software.
It is the Ouroboros, the snake eating its own tail. The very technology that the software industry built is now coming for the software industry's fundamental business model.
Which leads us directly into the second part of this triple threat. Because if AI is the predator here, if AI is the thing destroying the software companies, you would think the company selling the weapons, NVIDIA, would be completely safe.
You would think so. They are the arms dealer in this war.
They make the chips that run the agents. So I looked at the earnings this morning.
Yeah.
And I mean, come on.
They were staggering.
NVIDIA's Q4 fiscal 2026 revenue was $68.1 billion, up 73% year over year.
$68 billion in a single quarter.
In a normal world, the CEO is popping champagne. The stock should be up 10% on that print. Instead, it sank nearly 4.6%.
Welcome to the expectation treadmill.
The expectation treadmill.
And it is moving at a speed that I do not think we have ever seen in financial history. When you are valued at these levels, when we're talking about multi-trillion-dollar market caps, great is a failure.
Great is just not enough.
Spectacular is just okay. To move the stock higher from here, you need to be literally impossible.
They just didn't have a Yellow Pages moment.
No, they did not. And what investors were looking for was not just incredible revenue today. The market already knows NVIDIA is selling every chip they can print today.
Right. The demand is obviously there right now.
But the market wanted a catalyst. They wanted something that guaranteed exponential growth for the next 5 years. They wanted to hear that demand is accelerating even faster than before. But instead, they got stability.
High growth stability. But still stability.
Exactly. And stability does not support a valuation that prices in infinite expansion.
And then there is the CapEx fatigue. I feel like this is the buzzword of the month.
It really is the elephant in the room right now. We need to talk about the big five.
Alphabet, Microsoft, Amazon, Meta, Oracle.
The hyperscalers. They are projected to spend over $650 billion in 2026 alone on AI infrastructure.
$650 billion. That is an almost incomprehensible amount of money to spend on chips and concrete and cooling systems.
It is entirely unprecedented in the history of capitalism. And the problem brewing right now is ROI anxiety.
Return on investment.
Yes. Investors are looking at a company like Microsoft and saying, okay, you are spending $50 billion a quarter on this stuff. Where is the revenue matching it?
They are pivoting from how many chips are you buying to how are you going to make this money back?
And this circles right back to the Citrini report we just talked about. This is why the triple threat is so interconnected.
Walk us through that connection.
If the ultimate result of all this massive infrastructure spending is agentic AI,
right,
and agentic AI destroys the pricing power of the software industry.
How do you make the money back?
Exactly. That is the feedback loop from hell. If Microsoft buys billions of dollars of NVIDIA chips to build these autonomous agents, and those agents make software cheaper and cheaper to produce and consume, Microsoft is essentially spending billions of dollars to deflate its own end market.
They are digging a very, very expensive hole.
That is the fear gripping the market today. It is the show me the money phase of the AI boom.
And there's a historical precedent for this fear, too. The DeepSeek moment.
Oh, absolutely. The DeepSeek moment echoing from January 2025.
Let's remind people about that because it was a huge deal at the time.
Right. So remember when the Chinese lab DeepSeek released the R1 model?
That was the one that was incredibly cheap to train, right?
Yes. It was shockingly efficient. It proved to the world that you did not actually need the biggest, most expensive computing cluster on Earth to get high-level reasoning capabilities.
And that terrified the market.
It sent shockwaves through the hardware sector because it suggested that the moat of massive capital spending might actually be an illusion.
If AI models become a commodity, if they are cheap to make and cheap to run,
then the demand for NVIDIA's absolute highest-end, most expensive, highest-margin chips might soften.
So NVIDIA is getting hit from both sides of the equation today.
Squeezed from both ends.
On one side, investors are worrying that the customers, the big tech hyperscalers, are going to eventually run out of money or run out of patience from their own shareholders.
The CapEx fatigue.
Right. And on the other side, they worry the technology itself is getting so efficient that you just don't need as many chips to get the same result.
And that creates the sell-off despite blowing out the earnings number. It is not about the $68 billion they made last quarter. It is about the deeply rooted fear that 2027 revenue might only be $50 billion.
The market is trying to price in the peak.
They are terrified they are buying the top.
So we have the software companies basically dying today because of the fear of agents. We have the hardware companies sliding because of CapEx fatigue and efficiency fears. The NASDAQ is just bleeding out.
Yeah.
But, and here is where you really need to pay attention to the screen today, the Dow Jones is green.
And this brings us to section 3 of our discussion today, the Great Rotation.
Or as you called it earlier, from code to concrete.
Code to concrete. It is the defining trade of this exact moment in time. In a world where digital assets are highly uncertain, where we literally do not know if SaaS is a viable business model, 5 years from now, investors are fleeing to things they can touch.
Tangible assets.
Physical reality.
Physics. Yes. I was looking at the leaderboard for February, and it is like stepping into a time machine back to 2008.
It really is.
Valaris is up 61% in February alone. Oil States International is ripping. Cosmos Energy, these are not trendy tech startups. These are drillers. These are rig operators.
Energy and materials, that is exactly where the safety trade is moving right now, and there is a very specific, very rational logic to it.
Let's hear it.
If I own an oil rig in the Gulf of Mexico, an AI agent cannot disrupt that rig.
No matter how smart it is.
An AI agent cannot write a line of code that magically makes crude oil come out of the ground without a physical drill bit turning in the dirt.
You cannot hallucinate a barrel of crude oil.
Exactly. So the very definition of what constitutes a business moat is shifting before our eyes.
Because for the last 10 years, the moat was always network effects.
Network effects or high switching costs in software. That was what every venture capitalist looked for.
Sticky user interfaces.
Right. But today, the new moat is having a government permit, having a physical pipe in the ground, and having a physical asset that you simply cannot replicate with a massive server farm in the desert.
Utilities and telecoms are a huge part of this rotation too, right?
Oh, they are massive winners right now. Because
Yeah.
if you take a step back and think about it, if this entire AI future actually happens exactly as predicted, what does it need more than anything else?
Power. Just massive, ungodly amounts of power.
And data transmission. So the utility companies that own the physical power lines and the telecom companies that own the fiber optic cables in the ground, they win no matter what.
It doesn't matter who wins the software war.
It doesn't matter if OpenAI builds the best agent, or Google, or xAI. They all have to plug into the wall. They all have to pay the electric bill.
They all pay the toll to the physical infrastructure owners.
So it is a classic pick and shovel play, but the shovel is a literal physical shovel this time around.
It is a defensive rotation into reality.
And frankly, this rotation is being dramatically accelerated by the fact that the macro picture is terrifying right now. If you are a portfolio manager worried about the world falling apart, you buy oil and you buy gold. You do not buy a CRM company trading at a massive price-to-earnings multiple.
Let's talk about that macro picture, because we really cannot ignore the wall of worry coming out of D.C. and Geneva today.
We can't.
This isn't just standard market dynamics at play. This is legal and geopolitical chaos bleeding into the tape.
The Supreme Court ruling on tariffs is a highly critical piece of this puzzle today. We need to explain this carefully because the nuance really matters for how you position yourself.
Right. So just to catch everyone up, the Supreme Court struck down the president's use of IEPA.
The International Emergency Economic Powers Act.
Right. The president tried to use that for broad sweeping tariffs, and the court struck it down. And I remember reading that alert and thinking, okay, the markets will love this. Free trade is back on the menu.
And that was the knee-jerk reaction on the trading desks for about 6 minutes.
Until the other shoe dropped.
The president did not just accept the ruling and walk away. He immediately signed a brand new executive order using a completely different statute, Section 122 of the Trade Act of 1974.
Section 122. I feel like literally nobody has talked about Section 122 for 50 years.
Most people haven't. It is a balance of payments authority. It technically gives the president the power to impose tariffs if the United States is facing a massive and sudden trade deficit.
But here is the real kicker for the market today. He didn't just reinstate the old tariffs under this new rule.
No, he raised them. He raised the global tariff rate to 15%. It was only 10% before the court struck it down.
So the Supreme Court basically said you can't do that. And the president turned around and said, watch me. I will use a different law, and I will make the tax even higher.
And this creates absolute administrative chaos across the entire economy. Think about a supply chain manager at a major company right now. Target or Ford or Apple.
They have no idea what is going on.
Do you get a refund from the government for the tariffs you already paid under the illegal IEEPA order? Nobody knows.
Are these new Section 122 tariffs permanent?
Well, the law actually says they expire in 150 days unless Congress acts to extend them.
Oh, wow. That is a nightmare for planning. So we literally have a 150-day clock ticking down right now.
Yes. So no business in America can plan their supply chain more than 5 months out. And uncertainty is the ultimate enemy of capital investment.
Right. If you don't know your input costs in 6 months, you don't hire new workers.
You don't build new factories. You hoard cash.
Or you buy physical commodities to hedge against the massive inflation that a 15% global tariff is going to cause.
Bingo. Tariffs are inherently inflationary. A 15% tax on imports means prices at the store go up. And if prices go up,
The Fed can't cut rates.
the Fed cannot cut rates as aggressively as the market wanted. And if interest rates stay higher for longer, those high multiple tech stocks suffer even more. It all connects right back to the rotation out of tech and into concrete.
It is all connected. And then just to dial up the global anxiety even higher, we have Geneva.
The indirect nuclear talks with Iran.
This is the massive binary risk hanging over the entire energy market today. We currently have the largest U.S. naval buildup in the Middle East in 2 decades.
We are talking about multiple carrier strike groups just sitting off the coast.
And oil is sitting at around $65 a barrel right now. That feels almost weirdly low considering the literal armada sitting over there.
It is strangely low, but it is swiveling. It is balancing on a knife's edge today. The market is just waiting for a headline out of Geneva.
Because if there is a diplomatic breakthrough, if they actually reach a new nuclear deal,
Oil could crash to $50 a barrel easily. The geopolitical risk premium would vanish.
but if the talks collapse entirely today, or God forbid there is a physical skirmish in the Strait of Hormuz that blocks the oil tankers,
We go to $100 or $120 a barrel overnight, no question.
and that is exactly why these energy stocks are acting as a massive hedge.
Smart portfolio managers are looking at this board and saying, I need to own Exxon or Valaris right now, because if the geopolitical situation explodes, my tech portfolio is going to tank, but my energy stocks will spike and save my overall return.
It is insurance. You are basically buying financial insurance against World War III.
It is a very grim way to look at it, but it is completely accurate. And if the global risk wasn't enough, we have the domestic gridlock holding us back too.
The DHS shutdown.
Yes, the Department of Homeland Security is partially shuttered.
We're on day 12 of this shutdown now, and this is entirely over the immigration standoff, right?
It is. It all stems from the Alex Purdy case.
The shooting of the 2 citizens by federal agents in Minneapolis, that was just a horrific story.
It was a tragedy, and politically it has become an absolute line in the sand for both sides.
Because Senate Democrats are demanding major structural changes to the agency now.
Right. They want mandatory body cameras. They want strict bans on masks for IC agents in the field, but the administration is completely refusing to budge on any of it.
So we have a total stalemate in Washington.
And economically, a partial government shutdown is a slow, steady drag on the system. It slows down processing at the borders, it slows down federal hiring, it stops contract payouts.
And it definitely contributes to that general sense of dysfunction.
It was a major factor in the Q4 GDP slowdown we saw. Growth slowed all the way down to 1.4%.
So let's just summarize the mood music for a second here. We have AI agents threatening to destroy software margins.
Right.
We have sudden 15% global tariffs creating massive inflation risk.
Yes.
We have tense nuclear talks creating extreme war risk. And we have a domestic government shutdown actively slowing the U.S. economy.
It sounds totally apocalyptic when you list it out back to back like that.
It really does.
Yeah.
But, and here is the massive twist that makes this entire deep dive so necessary if you walk out onto the street today and ask a regular person how they're doing.
They're actually feeling pretty good.
This is section 5 of our breakdown, the consumer reality check.
And it is arguably the single most important counter-narrative to the Wall Street doom loop playing out today.
I was looking at the Virginia Consumer Sentiment Report for February, and consumer sentiment is actually rising.
It is climbing steadily.
Expectations are the highest they have been in an entire year.
Yeah.
How is that even possible? Are people just not reading the news about the tariffs and the AI crisis?
They are living their actual lives. They're not reading Citrini research reports on Substack. For the average person on Main Street, only 2 things really matter at the end of the day. Can I get a job, and how far does my paycheck go at the grocery store?
And the answers to those questions right now are
The answers are really good. Wage growth is currently sitting at 3.7%.
And inflation, despite all these looming tariff fears we just discussed, is currently at 2.4%.
That is a very positive spread. That means real inflation-adjusted purchasing power is actually going up for the working class.
For the first time in a while, wages are beating inflation comfortably.
And gas prices have been ebbing lately, too, which is a massive psychological booster for the American consumer. People look at the price at the pump more than anything else.
So while Wall Street is completely freaking out about the 2028 intelligence crisis and massive software margin collapse,
Main Street is saying, hey, I got a raise this year, and eggs are cheaper than they were last year.
it is this massive disconnect between the financial economy and the real economy.
Because the financial economy is a discounting mechanism. It is always looking 18 months, 36 months out into the future. It is pricing in the pure risk of what might happen.
But the real economy lives right now, in the present.
And the present reality for the consumer is actually quite robust.
Which explains why the big Wall Street analysts, the major banks like Deutsche Bank and Oppenheimer, haven't actually slashed their end-of-year target.
No, they are holding firm.
I saw S&P 500 targets still sitting at around 8,100 for year-end. That implies a massive, massive rally from where we are today.
They are fundamentally betting on the bull case prevailing once the dust settles.
And what is the bull case right now?
The bull case is that underlying corporate earnings are still very strong across most sectors. We are highly likely getting corporate tax cuts from this administration eventually. The Fed will eventually cut rates once the tariff shock is absorbed.
And what about the AI fear?
This is the ultimate irony of the day. The exact AI efficiency that is absolutely terrifying the software investors. It is fantastic news for literally every other business in the world.
Oh, right. If I run a logistics company or a manufacturing plant, and I can fire my incredibly expensive software vendor and just use a cheap autonomous AI agent, instead my margins go through the roof.
Exactly. One man's revenue collapse is another man's margin expansion. If AI drives the fundamental cost of doing business down across the board, total profits for the broader S&P 500 should explode upwards.
Wall Street knows this.
They know it. They just aren't sure exactly who captures that massive value yet, which is why we have this violent rotation and volatility today.
So let's bring this all together for you listening at home. We have covered a massive amount of ground today, from the potential death of SAWs to the rise of offshore oil drillers, from Section 122 tariffs to the surprisingly resilient Virginia consumer.
It is a lot to process.
What is the main takeaway you should walk away with today?
The primary takeaway is that we are in a historic transition period, the Great Realignment. The easy money era, the decade where you just blindly bought growth stocks and went to sleep, is officially over.
You can't just buy the index ETF and expect 20% returns anymore.
No, you have to be highly discerning. You have to actively ask the hard questions about your portfolio. Does this company have a physical, tangible moat?
Is this software company actually building something unique? Or is it just a thin wrapper around a database that an AI agent is going to replace tomorrow?
Is this energy stock a good hedge against a geopolitical war? You have to do the work.
It sounds like a forced return to actual fundamental investing, like reading balance sheets and understanding how a business model actually works.
Novel concept, right? But yes, the market is violently punishing laziness right now. If you are just blindly following the tech narrative from 2024, your portfolio is getting crushed today.
But if you are looking at the new reality, the shift from code to concrete, you are finding massive opportunities. I want to leave you with a final provocative thought today. We talked a lot about friction in the first half of the show.
Right, the whole Citrini thesis.
And how the ultimate goal of agentic AI is to permanently remove friction from the economy.
A totally frictionless economy. That is the Silicon Valley utopia.
But here's the thing I cannot stop thinking about. If your job or your investment portfolio or your retirement plan relies on companies that monetize friction,
which a huge part of the market does,
then isn't efficiency actually your enemy?
That is the ultimate paradox we are facing. As consumers, we desperately want everything to be cheap, fast, and instant. We want zero friction in our lives.
But as workers and as investors?
We get paid to manage the friction. We get paid to be the middleman, the manager, the interface between two systems.
If the AI completely removes the friction, where does the profit actually go?
Does it flow to the energy company powering the AI? Does it go to the chip maker?
Or does it just vanish entirely into consumer surplus, meaning things just get cheaper for everyone, but nobody makes a massive profit margin ever again?
Profitless prosperity.
That might be the exact world we are heading toward. A frictionless world where everything is incredibly cheap, but no corporation can defend a profit margin.
That is a terrifying and fascinating thought to end on. Definitely something to deeply mull over while you watch your portfolio today.
Keep your eyes on the physical assets.
Indeed.
Thanks for diving in with us today. We will see you next time on the Pro Ticker Deep Dive.
Goodbye, everyone.